If you're an investor that wants to buy and hold, grow money passively, and avoid expensive fees, then growth ETFs might be your kind of investment. Basically, growth exchange-traded funds, or simply growth ETFs, are designed to outperform the market so that you can gain the biggest assets in the safest ways possible. Hey, welcome to Stock Market Mate. Today, we'll talk about the top 5 best growth ETFs for 2022. We picked out the best ones so that you can have an easy and effortless walk towards having great returns. Make sure to subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Growth investing is one that continues to capture many investors' attention. While there are no hard and fast rules for the style, incorporating growth stocks into your portfolio involves finding names that are expanding faster than their sector peers or broader market averages. Basically, growth ETFs are designed to invest in a basket of stocks whose underlying companies have the potential for rapid growth, as opposed to stocks whose prices are relatively undervalued. Growth ETFs are typically expected to grow faster compared to the overall stock market. However, they are usually subject to additional volatility, especially during times of economic weakness. Let's have a quick rundown of the pros and cons of investing in growth ETFs. The biggest benefit of choosing this type of investment is that it generates high returns. Growth ETFs typically invest in companies that are projected to have above-average growth rates relative to their counterparts. This allows you to access stocks that can result in significant, and in some cases, exponential returns. Growth ETFs are also a little bit more tax-efficient than mutual or index funds. This is because, in those types of funds, the mutual funds manager needs to rebalance those index funds manually, and when they do, they incur capital gains. After that, they pass those capital gains to their shareholders. It's not the same case with ETFs, and this is why you're getting a tax advantage. However, a potential drawback is that it can be volatile. Growth ETFs are often more volatile than their value ETF counterparts. You also won't get a regular investment income since growth stocks typically do not yield dividends. This is because profits are reinvested into the company, and for that reason, growth ETFs may not be suitable for investors who seek steady returns such as retirees and people who shy away from volatile returns. With that being said, let's start discussing our list for the top 5 best growth ETFs for 2022. Number 5. VBK Vanguard Small Cap Growth ETF. The Vanguard Small Cap Growth ETF is a passively managed exchange-traded fund designed to offer broad exposure to the small cap growth segment of the US equity market. The fund is sponsored by Vanguard and it tracks over 630 different small cap stocks. By definition, small cap stocks are companies that have between a market cap of $300 million and $2 billion. They're basically smaller companies with big potentials. 24.4% of Vanguard's holdings are in healthcare, industrials, technology, and consumer discretionary companies. And what's great about this fund is that none of the holdings represent more than 0.67% of the overall assets. This means that your investments aren't threatened when one of these companies goes bankrupt because you still have 638 stocks to carry the ETF up. Furthermore, Vanguard has amassed assets over $16.10 billion, making it the largest ETF attempting to match the small cap growth segment of the US equity market. Annual operating expenses for this ETF are 0.07%, making it one of the least expensive products in the space. However, one of its drawbacks is that it's the most volatile item on today's list. Number 4. IWP iShares Russell Midcap Growth ETF. Designed to provide broad exposure to the midcap growth segment of the US equity market, the iShares Russell Midcap Growth ETF is a passively managed exchange-traded fund. Sponsored by BlackRock, this fund has amassed assets over $14.13 billion, making it the largest ETF attempting to match the midcap growth segment of the US equity market. Mid-cap stocks are companies that are neither so large that they need big numbers to post significant improvement in their top or bottom lines, nor so small that just a few bad quarters could really threaten operations. They have between $2 and $10 billion in market capitalization. This fund is comprised of 356 different stocks, and their largest sectors belong to IT, healthcare, and industrials. None of their holdings surpass 1.43% of the overall assets. Since it was created, iShares has been returning about 9.9% annualized, but in recent years it's been returning in about 19%. In terms of expense ratio, it's more expensive than Vanguard, standing at 0.24%. If you're looking for growth but don't want to take on the larger risks that can sometimes come with younger and less established corporations, IWP could be a nice compromise. Number 3. iBuyAmplify Online Retail ETF. While Amplify isn't exactly a big asset manager like the other firms here, its tactical Amplify Online Retail ETF is still plenty popular. With more than $500 million in assets at present, This growth ETF doesn't focus on a specific market cap size, but rather focuses on companies that generate their primary income through online sales. It's also well diversified, despite a targeted approach in just 60 total positions. The modified equal weight methodology ensures no single stock dominates the fund. Each of the fund's top 10 holdings is all below 3% of assets each. It also means that while some of the obvious e-commerce megastores like Amazon.com do make an appearance, they're no more important than niche players from travel booking portal Airbnb to ride-sharing giant Uber Technologies. Disclaimer: this fund is way more expensive than any of the items on our list, with an expense ratio of 0.65%, which is almost 9 times the Vanguard average. With this amount, there should be great returns, right? Luckily, this is the case. The returns of this ETF are quite astronomical that it reaches 38%. What's even more impressive is the 3-year return, which is about 40.57%. While the returns are there, it's still volatile. Number 2. QQQ by Invesco. Certain sectors are naturally more prone to having growth stocks in their midst. Technology, healthcare, and consumer discretionary tend to focus on fads, innovation, and cutting-edge products more so than, say, industrial manufacturers making ball bearings. Investors looking to add a dose of growth stocks to their portfolios may want to focus their attention on these sectors, and the Invesco QQQ could be one of the easiest ways to do just that. The Invesco QQQ ETF, which tracks the Nasdaq 100 index, ranks in the top 1% of the large-cap growth funds. Since its formation in 1999, QQQ has demonstrated a history of outperformance, consistently beating the S&P 500 index. Since it has been created, this fund has had a return average of 9.38%, and for the past 3 years, it's been 27.34%. Its expense ratio is 0.2%, which is pretty decent. Amazon, Microsoft, and Apple are one of their top holdings. Those three actually comprise about 30% of the overall assets. Some investors might say that the QQQ has plenty of overlapping holdings with the S&P 500 ETF, but in 2021 it has actually returned over 48%, and the S&P 500 has returned about 19%. While there are overlapping holdings, the returns do favor QQQ. Overall, adding in the very swift trading volume, low bid-ask spread, and the rock-bottom expenses, the QQQ could be one of the easiest ways to add a touch of growth to any portfolio. Number 1. VUG Vanguard Growth ETF. The Vanguard Growth ETF is the leader among large-cap growth options with a massive $85 billion under management. Its approach is simple and cost-effective, holding a group of about 280 primarily large-cap stocks with growth characteristics and charging a trivial 0.04% in annual fees. Perhaps unsurprisingly, VUG, which weighs its holdings by market capitalization, is biased toward blue-chip technology stocks, with top holdings including Apple and Microsoft, and technology representing about 50% of the total assets at present. Indeed, the median market cap of all holdings is about $190 billion because VUG only includes the biggest growth names out there. Of course, that probably won't scare off investors who actually are looking for this kind of bent toward tech and away from sleepy sectors like telecom and utilities. VUG is a simple way to gain cheap, diversified exposure to the names that probably come first to mind when you're thinking about growth. It's one of the least sophisticated growth ETFs around, but it is popular for a reason because of its straightforward set-it-and-forget-it approach to growth via large US stocks. Bottom line, ETFs can provide above-average returns and they can offer conservative long-term growth. However, you should also know that they carry more risk because fast growth tends to be accompanied by higher volatility. Well, that's about everything. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!